think, as everybody knows, it's been talked to several times today, we're on the cusp of a record-breaking year, and we have a pretty bullish outlook for 2016. So deal multiples are expanding. Buyers much more willing to consider valuations that would have been considered overheated just a year ago. That's certainly what we're hearing in our dialogue, both here in the United States and from our office in London. And I think we've assembled a great panel of individuals here today just to talk about those valuations. This session's being led by Jason Kimball. Jason's the assistant MD responsible for corporate valuations at Generational Equity, and he's brought with him 4 individuals who are actively involved in analyzing, assessing, and ideally putting those valuations where they belong. Gentlemen?
Start with a quick overview of these guys, then let them each go into the sort of work that it is they do, and then start off with a few questions, and then take it from there in a dynamic sort of fashion. I'll start on the end here. Terry Mackin, who is not in your brochures, was a perfect last-minute substitution for Brendan Hofstetter. Terry is at Generational Equity as well. He has over 15 years of mergers and acquisitions experience, working with middle market clients, helping them reach their professional and financial goals. Prior to Generational Equity, Terry was president of Inventus Investments, a middle market mergers and acquisitions firm in Dallas. Mr. Mackin's professional experience also includes working with Citigroup's Capital Strategies division and as vice president for a Kansas City-based M&A firm specializing in consolidating markets, including healthcare, heavy equipment, and telecommunications. He's at Generational Equity, one of the leading middle market M&A firms in North America. Next, closest to me here, we have Satish Raman, and he's the global head of corporate development at Sutherland Global. Satish has more than 18 years of experience in the areas of mergers and acquisitions, equity public offerings, debt financing, corporate development, board support, and investor relations. He's also been involved in foreign strategic partnerships, several large non-standard client deals and wins, and global expansions of corporate finance activities. He's at Sutherland Global Services, a global provider of business processes and technology management service offerings, an integrated portfolio of analytics-driven back office and customer-facing solutions that support the entire customer lifecycle. On the other side of Satish, we have Ross Gatlin, actually down near Terry, managing partner at Profit Equity. Mr. Gatlin is focused on holistic value creation. That's identifying, making, managing, and realizing a portfolio of control investments in strategically viable asset-intensive middle market companies where there are significant value creation opportunities. He's also responsible for day-to-day operations of the partnership in relations with limited partners. His track record includes over $2.5 billion of value created with the same distinct investment strategy over the last 16 years. Profit Equity is a private equity firm that uses proven data-driven analytical techniques coupled with over 100 years of investment and management experience to invest in, unlock, and realize future value today. And finally, Drew Dorweiler is the managing partner at Dartmouth Partners Limited. Drew enjoys over 27 years of experience in the valuation of hundreds of private and publicly held companies in business valuation, corporate finance, and litigation, support mandates on a global basis. He has frequently participated as a financial advisor in corporate acquisitions, divestitures, and startups. He's at Dartmouth Partners and Limited is a boutique business valuation, litigation support, transaction advisory, and corporate financial firm headquartered in Montreal, Canada, with offices in Chicago, Illinois, and Hong Kong. Gentlemen, I'd like to thank you for joining us today. The overall thrust of the panel is to get a feel for the trends that we've been seeing on an anecdotal sort of basis in deal structures and types of buyers and valuation. We all see the industry-wide numbers And the good thing about those numbers is they get a feel for the overall trend, but the bad thing is they kind of wash everything out on a deal by deal and an individual company sort of basis. So one thing that has been a fairly steady trend since the recession has been an improvement in value multiples. But I wanted to kick it over to Ross on some of his thoughts that he's had on the deals that he's acquiring there. And before he gets into that, Ross, start off by telling us the sort of companies you focus on and the day-to-day operations there.
Thanks. Yeah, it's, profit equity, we're looking for strategically viable businesses that have greater potential than their current operating performance. And so we look for companies with good bones, so to speak, and then we've got a multidisciplinary team of strategists, operators, and financial engineers that helps diagnose that value creation plan, structure the transaction, and then implement the plan post-close. So there's no other team that comes in post-close. And so we've been able to successfully partner with a lot of owners who really want to take that business to the next level and monetize in a phased approach. And so that's been good for us. And the sort of businesses, they tend to be asset intensive, businesses with some sustainable barriers to entry or competitive advantages. And so we're really looking for the strategic diamonds in the rough where we can optimize that full potential. And with that in mind, I'm pleased to tell you we've paid some of the highest multiples in the world. I was thinking about that the other day. But you have to think about this a little bit. When we bought a crane business at the end of 2010, I'm pretty sure it was a 45 times EBITDA multiple that we paid. So you'll be very pleased to know that we are very flexible in that way. But the reality is that there was tremendous asset value in the cranes. It was a unique time in the market, and the EBITDA or the cash flow was very compressed. And so I think sometimes these multiples are a little bit misleading, right? And that's really what you're looking for, is a group that understands the difference between compressed EBITDA and rich asset value and a good business that really needs a leg up and an opportunity versus a broken business that can't be fixed and where the problems are chronic strategic flaws that can't be fixed. And so that's really what we go about the work of determining the difference in. And we've had other businesses, similar dynamic, where the multiple looks quite high, but we're looking at the asset value as our security interest and the rationale along with the strategic viability and a good plan of attack for optimizing performance to sort of get that in balance in the early stages of the transaction. And so there is a bit of a leap of faith. We think it's undergirded well with the strategic strength and the asset value, but certainly some of the multiples contribute to this dynamic in terms of their optics.
When you think of underperforming, is it necessary that the company have a strong asset base, as in that deal you mentioned there? So asset base is pretty broad. So we've had deals where there's a interesting collection of intellectual property. I did a polycarbonate lens manufacturer in the early 2000s that, polycarbonate was the clear emerging substitute to glass and plastic in a slow to change industry. But you had to really get through a lot of noise and cloud cover to figure out that there was a good business within there that could be optimized. And so we have a lot of examples like that. Another one was a restart where we took a management team that had displayed the ability to create a winning brand within medical uniforms, and we restarted them with their own brand. And so, what were the assets when we started? A relationship with a guy who'd been successful before, and then we put the capital in. Other times, there's a potpourri of assets. Brian Hagee's out there with our shop, and he's here for an incredible deal that he helped lead, where now we've got the third largest fleet of modular buildings in the United States, and that was covered with assets. But again, if you looked at the multiple, we overpaid. Yet when you look at the asset configuration in today's EBITDA, no, it turns out we didn't. It was, there's a right time to do a good deal with sellers and pay them a reasonable value, and then be part of that upside. I think people can get a little exploitative, in these situations sometimes and miss a good opportunity. Good. Terry, you're representing the sellers of the business. Tell us what a typical sort of company looks like for you.
Well, I'm obviously the odd man out here because I'm the sell side, and unfortunately we were not involved in any of those deals.
There's still time.
I think the important thing to understand about generational equity, if I can take a couple minutes and at least talk a little bit about us, is, and I use a word, education. Our objective when we bring a client in is to get them to understand what they can anticipate about the entire process of selling their business and how we're going to be able to help them along the way. And since we are an agnostic firm, we don't specialize in any particular industry, it puts us in a position where we have to do a lot of research. We have to get in and understand exactly what valuations look like in any individual space, and then bring them into the conversation when we're educating the client. Part of what we do right up front is we provide them with an evaluation of their business based on those metrics that we find in any one industry. And with that, it then gives us a platform to work from so that when we do put that business out in the market and we do start talking to guys like this, we're both on the same page in where we believe value should be or could be. And then, of course, we look to them to find the premium in that business. So, for example, when you've got a private equity firm that already has a platform in that space, they're going to take a different view about how they can take that business and roll it into what they have. Since we're on the lower middle market, most of the businesses that we have are either going to be, it could be an initial platform, but for the most part, they're going to be a bolt-on. So where they can take that information or take that business and roll it into something they already have, then they can create value there that goes beyond maybe a standard multiple for that industry. They can also bring in the people that they have on staff as part of the existing firm that they have, and that firm may know that business, the business that we're representing in that space, and can lend a little bit more value to it. Ultimately, we would like to get premium values for all of our clients, and we'd like to get them above and beyond what the multiples are in any one space. But our objective through that education is to try and keep the process down to where we can be successful. Because in the end, if I put a business out on the market that where a client has a belief in his business that goes well beyond a standard valuation, we believe a good starting point for that space would be, these guys aren't going to be happy with me because they're going to spend a lot of time coming to meet with that client, getting together and coming up with an evaluation on their own, getting attorneys involved and so forth. And the end result is they're going to come back with an offer that we're not going to be able to get together on and be able to put a deal together. And that's ultimately where our success runs.
Now, one of the trends and things we've been talking about are the valuations and ultimately how they've been growing. But Terry, one of the things you and I were talking about is it seems like more often than not, the deal ultimately gets done not necessarily at the highest offer. Mm-hmm. We have such a focus on value, but there's a lot of other factors that come into play. Can you give some examples where that's happened and the reasons for that?
Sure, absolutely. I think that when you own a small business and you're approached by generational equity with the idea that you might be interested in an exit strategy, a lot of the focus, certainly in the initial stages for that business owner, is how much is my business worth? How much are you going to get me for my company? And so it's focused on the dollars. And that gets back to what I said earlier about education. Our objective is to certainly give them an evaluation, give them a good benchmark based on what we understand about that individual industry. But my experience has been that, at some point in the process of selling, and that is once we've evaluated the business, we put it out on the market, we've started to talk to buyers, whether they're financial guys or they're strategic guys, whatever they may be, there comes a point where the client begins to realize that this isn't just about dollars. It's not just about selling a business. There's an emotional factor here that they need to take into consideration. And because we deal in the lower middle market, most of our clients either started the business or it's a family business, some sort of legacy that now they have to make a decision as to whether they want to see that continue. So for us, to be there, to be that psychologist for them at that point, is very helpful for them because they're making a decision as to whether a sign's going to remain over the door, whether it's going to be consolidated somewhere else, and they're going to have to let a bunch of employees go. I mean, I had a client back a few years ago where he employed 50% of the people in that particular town he was in. And when he eventually got around to the fact that there's a possibility that his business could be consolidated and moved elsewhere, the value that he was willing to accept for that business changed. And what I was reflecting to Jason was that I put a number on it, could be higher, but 80% of all the deals that I've ever done were not for the most amount of money. They may have started out with that being the goal, but the end result was that the client made a decision at some point, based on all the offers that were on the table, that the one that he chose fit not only a financial parameter that he could accept, but it also fit with all the other emotional parts of what he began or eventually got around to understanding were an important part about making the decision.
Good, good. Wanted to shift gears a little bit and talk about the trends we're seeing in types of buyers. And in that focus, wanted to go to Drew, being on the valuation side of things, a man after my own heart. First, tell us a little bit about your firm, the companies you're working with, and then lead into how you view strategic versus financial buyers, things along those lines.
Certainly be happy to, Jason. So again, at Dartmouth Partners Limited, we are a business valuation boutique, and we're industry agnostic, working both buy side, sell side, doing quite a bit of transaction related work. And again, we're based in Montreal. We have offices in Chicago, and in 2 weeks we're opening our Hong Kong office. So some of the pronounced trends, first of all, I'd say in the last, well, since the recession, we're seeing the lion's share of deals done with strategic purchasers. It just, I mean, they're the ones we're seeing that are willing to pay the premiums that are, again, on the buy side. They're looking to achieve, because organic growth is virtually non-existent, they're looking to achieve certain strategic advantages, additional cash flows, enhanced margins, and they're willing to pay a significant premium over and above what we call fair market value or a financial return for the privilege and opportunity of securing that sort of an asset. One thing that's coming to mind I found really interesting, based on what you were saying, Terry. Again, as I just said, we're industry agnostic, but I've done over the past 30 years of my work, I valued and quite a few professional sports franchises and intangible assets. And one thing that just about within the last, let's say, 2 years, I represented a buyer who was interested in purchasing the Buffalo Bills. The only thing is, as it turns out, the estate of Ralph Wilson, when there was an inviolable contract or clause in his will that said that when the team is sold, it can never leave Buffalo. And the people I was working for, they were literally willing to pay almost twice the price for the team if that somehow could be lifted, and the team moved to another city. Ultimately, it didn't work that way, but it's just, again, it's quite interesting. There are considerations out there in buying and selling businesses that are purely not economic.
Absolutely. Satish, I wanted to turn things over to you. Tell us a little bit about the sorts of companies you work with, and also you're on the buy side sort of things, but have a slightly different or added focus in the regard of working on both equity and debt perspective. So go ahead and take it from there.
Sure. Thanks so much, Jason. So Sutherland is a services company, very broadly defined. So you can think of us like the Accenture of the middle market, if you will. We're still privately owned. We're a little over $1 billion in top-line revenues. We have about 40,000 employees globally in about 20 countries and 5 continents. We've been looking through a mix of both corporate venturing, corporate investments, as well as strategic acquisitions for a fair bit of time now. We did our first real transaction back in 2009, 2010, just at the dawn of the recession, if you will. And we've done about 6 transactions on the M&A side and about 5 of them on the financing side, over the last 7-8 years. To come back to what Terry and Drew and Ross were saying, the way we think about it is probably a little different, but kind of aligns to what Terry said. For us, the focus is, do we understand the business that we're either investing in or buying in? Do we like the people that are running that business today, and can we as a company do business with them? What do we bring to the table that can improve the quality of the business, either by way of operations or cash flows or sales, as the case may be? But most importantly, what does it do to the mothership, right? So I think if we get past these 4 barriers, then we start attributing numbers to the business. We're not saying valuations are high or low, but it's simply a function of what is it that we're willing to pay based on the value that we see. So we've done deals for as low as 5 times EBITDA. We've done deals for as high as 21 times EBITDA. But at the end of the day, the thesis is, what is it going to bring us manifold over that standalone business today? So we've seen trends change, obviously, in terms of how sellers have adapted to strategic buyers over the last 5 or 6 years, especially with banks and the way they run multiple wide auction processes, to now it being literally targeted selling, if you will, where they know the appetite of people that are looking to come in and buy the asset, and not looking to just get the CIMs and get to management meetings, but not go beyond that.
Absolutely. Ross, I wanted to touch on the sort of deal structures you're typically trying to arrange, and perhaps how that deal structure and how that viewpoint has changed since pre and post-recession.
It's a really interesting facet of this business. Over a long period of time here, you've seen a real evolution, and it goes along the lines of what everybody's saying, particularly Terry there. I think it's a bit of an efficient frontier exercise for sellers to understand maximum value, and it usually involves something other than Santa Claus with a bag of cash. I always tell people, if they find Santa Claus and they get that deal done, first of all, get it done, get that cash, and then call me, because I got some stuff to sell Santa Claus too. We got plenty of things to sell him. But he's like the guy in the red coat. Everybody talks about him, but you can't quite find him, and it's not clear he really exists. And so I think people going through that process find a different efficient frontier, which is basically when they care about a company and they care about the people and they actually believe in the business, they're looking to take some chips off the table as part of their estate planning exercise at the right valuation, but then they really believe they're going to roll forward and participate in the next phase of value, because when they come to us, they're genuinely believing there's places to grow organically and acquisitively. There's real market opportunities that they can't realize on their own. And so we've seen that trend in a big way. And I don't think we've done a deal in the last 6 years where there hasn't been a significant rollover stake, a significant commitment by that same seller in the business going forward in some form or another, whether it's seller paper, rollover equity, a combination of the two, and they've been richly rewarded. We're fortunate that we have a track record that's really good for equity returns. And so ironically, that's become as big a calling card for us as anything, is the rational mathematical decision people make to say, here's my cash at close, and here's the likely value of my equity over the next 3 to 5 years. These guys have a track record that says, on average, I'm going to make a significant amount, and they got the tools and techniques, the track record to prove it. So I'm going to pick the right partner for my team, for my company, for my estate planning. It kind of works together. So for the people that are interested in that next level of value, they've got to pick the right partner. That's actually the #1 issue for them deep down when they drive through it all. And so you can offer, and they know if they take the highest offer, it's probably going to involve a capital structure that they probably couldn't sleep at night for all those employees to be part of. Those are people they care about. And so they got to do an intelligent deal, an intelligently designed deal. And so we see a lot of that. And we're able to bring to bear a lot of financial capabilities to make that happen. So a lot of rollover equity. Seller paper is an interesting way for people to defer income taxes. And, I'm not a tax planner, but there's a lot of creative ways to manage that tax liability over a phased approach that's pretty intelligent and is shown to be pretty valuable. And then, you've had things, that oxygen has come back into the debt lending space for these types of businesses, although there's been a little contraction recently in the lower middle market. But you've got some non-bank solutions for smaller scale businesses providing term B, non-amortizing debt that essentially allows you to stretch a little further. So we've seen that dynamic. You've seen the asset-based lenders go to their kind of aggressive toggle. What that basically means is a little stretch capital to go with the B capital, or even a C tranche or seller paper that goes on top of that to get all the way there. So you've seen, you've really seen this thing get going again. And I, honestly, it really hasn't come all the way back the way it could in the lower middle market.
Well, what we tell our clients, at least I tell our clients when we first sit down and we start talking about how deals can be structured, is that we've seen a lot of change since the recession in terms of how risk is going to be leveraged in the deal. And by that, obviously buyers look at businesses now, they see some historical track record, and if you go all the way back to the recession, in 2009, 2010, that was not a very good historical looking track record. And I think it really started there from a standpoint of how can you further mitigate risk, because there are so many things that are risky about buying a privately held company in the first place. And through that education, we start talking about the options that could be out there for them when they're looking to buy a business or looking to sell their business. And of course, you have strategic buyers who are still willing to do cash deals, but of course if a strategic buyer is owned by a private equity firm, then there may be an equity opportunity there.
Quasi-strategic.
With a strategic, there may be an earn-out piece that needs to be taken into consideration as part of that. And the end result is we want to leverage that with the client, because where his value expectations are on that premium side, and that business is not necessarily exhibiting all the things that we believe would be premium, we want to be able to have that extra kicker there that they can look at and say, yeah, if I kept 20% in this business, I could then leverage all of those things with their capital, with their people, with their systems, whatever it may be. And, at first, once again, getting back to the type of clients that we usually work with in the lower middle market, those clients are not necessarily, first of all, don't understand that aspect, don't realize that it would even be available to them. But once they get to hear the story that you guys have when you come in and sit down with them and so forth, one of my big beliefs in terms of how we do best at putting a deal together is allowing guys like Ross to sell our clients on their track record, on what they can do to be able to meet their expectations, mitigate fears that they may have about what's going to happen with the business, but ultimately to be able to use that entire valuation model as a way of being able to move the deal along, but also to provide the client with different options where, if we've done our job correctly, client is looking at 4 or 5 different offers. Sorry, that does occur all the time. But that those options then become something that they can look at individually and say, what's going to make the most sense for me? Which, as I said earlier, gets back to, is it all about the dollars, or is it about something else that's built into the deal that can then give them the ability to be able to sleep at night, as you said.
Okay, Satish, I'll put the same question to you that I did to Ross, just in regards to the typical sort of way you go about structuring a deal and how that's changed since pre and post-recession.
Well, we started investing post, or call it at the dawn of the recession. So the way we think about value and structure is pretty similar to what you guys were talking about. As long as we have alignment on values, We have alignment on business direction, not necessarily business goals, but the direction that the combined businesses are going to be doing. An alignment of the people in terms of the way they think, not just at a business level, but at an operational level. Then we're able to translate that into what I call the two halves of what comprises valuation in our heads, which is, are we willing to eat our own dog food about how we think about our business versus theirs, and not kind of, dumbing down the value for them just because they're smaller or they're very niche-y, but at the same time expecting them to put skin in the game to the extent of components like earnouts or deferred payments over 3, 5, 7 years. And so far it's worked for us on every single deal that we've done. All the founders that have come on board are still a part of the corporation today. There's no one that's left. So I think that's, if I can say it myself, is testimony to the way we think about how we structure it. So there is a fair bit of subjectivity involved. It's not, for us, multiple is the resultant of where we have a handshake on where the deal gets done, as opposed to the starting point on where we should peg the deal and think about price as a result of you.
Good. And Drew, from the valuation perspective, I know you mentioned thinking about structures in terms of the preferred structure and how you go about thinking about that. Would you elaborate on that?
Certainly. And again, I'm speaking as someone who values businesses, both sides of a transaction, day in and day out. I mean, I'm seeing all sorts of structures, but I think one point I really wanted to make everyone aware of, to the extent you aren't already, when I'm not valuing businesses per se, I'm on the board of trustees of the Appraisal Foundation, which is, again, for those that don't know the Appraisal Foundation, U.S. Congress created us 27 years ago to oversee and regulate the appraisal profession, both in business valuation, real estate appraisal, and personal property. In fact, this year I'm the chairman of the Business Valuation Committee. The reason I'm bringing it up, not to brag, but simply to make everyone aware on the deal structures and with respect to strategic premiums. We're actually putting together thus far it's 62 pages, an exposure draft that's going to be released possibly as soon as the end of the year it's called the Market Participant Acquisition Premium, and it's literally a 60-plus page document. How does someone go in and actually, it gives you guidance, how do you quantify a strategic purchase or a strategic acquisition premium? And it's, again, a little long. I mean, maybe, for those of you that like the good technical read, it's well worth it, because it will actually, for the first time, give you guidance as to factors to consider, how to crunch the numbers to come up with a price to be paid, especially if you're a strategic acquirer for an asset.
Well, good. And as a fellow accredited senior appraiser, I will brag on your efforts there, and we definitely appreciate that. So, running along time, Terry, I wanted to throw one of the final questions at you, just in regards to, we focused on types of buyers and types of structures. When you're running a deal from your side of the table, do you view strategic buyers versus financial acquirers any differently, and how do you go about dealing with them in regards to the deal?
Well, it's interesting because I think that I think the lines have kind of created a gray area between what is a strategic and what is a financial buyer. A lot of times clients will come to us and they'll talk to us about competition, about who they know who their competitors are, and who they know who the strategic buyers out there. What they don't realize, what sometimes we find out along the way, is that those strategic buyers are actually owned by financial and equity guys. And what's great about generational equity is we have relationships with a lot of these guys. We've worked with them before, we've done deals with them before, so we already have a very tight relationship that we can take advantage of. When it's strictly a strategic buyer, once again, I get back to what I said earlier about options. The objective here is to try to give a client an opportunity to be able to look across the table at different ways of selling his business and different people to sell his business to. And so a strategic buyer needs to be part of that. He also usually can set a bar that the client can wrap his arms around. So once again, if we're talking about a premium value for a business, and now we have a strategic buyer who is putting a value out there that's slightly lower, the client would tend to accept the fact that, you know, his business is, his baby's not the prettiest one, and the strategic buyer is telling him that's the case. Now, when you have a financial buyer who is also a strategic, now that lends itself to a different value because, once again, the strategic will be involved in the conversations about whether this is a viable opportunity, maybe because they know them, they've worked with them, or they've competed against them in the marketplace. But the financial buyers will also be able to talk that side of the deal and offer those different types of options that we were talking about, be it equity in the deal or an earn-out or whatever it may be. So it becomes a very compelling kind of a combination for us to be able to leverage as well. So depending on what that strategic buyer has in terms of his background or who's controlling the purse strings, that can have a lot to do with it. Ultimately, too, in this particular case, when you have a strategic involved and you also have a strategic financial involved, now it becomes a question of who wants it the most. And when you can get into that situation with additional options, chances are it's going to be the best for our client. And as these guys would attest to, you know, everybody wants to get a deal done that's fair. They're only going to go as far as they believe they can to make it work. But ultimately, what's our goal as advisors for our client? It's to push the envelope as far as we can on behalf of the client, and then let them make the decision as to what they think makes the most sense.
Great. That brings us to an end. I'd like to thank the panelists, and definitely looking forward to the rest of the evening. And it looks like we have refreshments next. So thanks, guys.